Let's talk about AI stocks. The returns we've seen have been, well, they've been absolutely stunning. For anyone paying attention, it has felt like a genuine technological revolution. But with every great boom, it's our job as prudent investors to step back, ask the hard questions, and really prepare for what might come next. So let's dive in and see what's really happening under the surface of this market. I mean, just look at this number. Since 2023, it has been an absolute rocket ship for some of these AI stocks. We're talking about companies surging by hundreds of percent, with some of the top dogs posting gains of over 900%. Look, these are the kinds of returns that you might see once in a generation. They've completely reshaped portfolios and rewritten the rules of market leadership. And right there, that's the tension, isn't it? This kind of vertical climb feels incredible on the way up, but history has a way of reminding us that momentum like this can be incredibly fragile. Markets fall in love with a great story, but they can be absolutely brutal when that story changes. The key isn't trying to predict the exact moment the music stops. It's about making sure you have a chair ready for when it does. So, how did we get here? Well, since late 2022, AI basically went from this niche, techie concept to the single biggest growth story driving the entire market. And this has led to a phenomenon that experienced investors watch very, very closely: massive market concentration. Okay, so take a look at this. This chart tells a really important story about hidden risk. What you're seeing here is that a tiny handful of mega-cap companies, all tied to this AI narrative, now make up a huge, outsized piece of the S&P 500's total value. Now, why does that matter? Because when the market's fortunes are lashed so tightly to just a few stocks, a problem with any one of them can send shockwaves through the entire system and through millions of investment portfolios. To really get a handle on the risks today, we have to look back. They say history doesn't repeat itself, but it sure does rhyme. And when you look at today's market, the excitement, the sky-high valuations, that feeling of this time it's different, you start to hear some very, very familiar rhymes from the past. Think about it. The Great Depression, the dot-com bust, the 2008 financial crisis, major economic downturns are, a recurring feature of modern finance. And if you look closely, you'll see a pattern. These deep contractions have often followed periods of immense speculation and heavily concentrated bets, whether it was stocks in the 20s, internet companies in 2000, or housing in 2008. Does this sound familiar? It's almost the exact same script, isn't it? In the late 90s, the promise was that the internet would change everything about how we live and work. Today, the promise is that AI will do the same. And here's the thing, both are probably true in the long run. The danger is that, in the short term, the market has a nasty habit of trying to price in decades of progress all at once. So, with all that history in mind, let's get really specific about today. I see 4 key red flags, 4 warning signs that are flashing in today's AI-driven market, and they look eerily similar to the conditions we saw right before previous downturns. Understanding these is the absolute first step toward building a more resilient portfolio. All right, here they are. We're going to walk through each one. First, valuation mania, which is just a fancy way of saying prices have gotten disconnected from reality. Then, the hidden danger, leverage and fragility. We'll also revisit that concentration risk we just touched on. And finally, the potential catalyst that could change the whole game, a policy trigger. Let's start with valuations. Just look at this chart. The gap between the price-to-earnings multiples for today's AI darlings and the long-term historical average for the rest of the market, well, it's just staggering. When a stock is trading more on a story than on its actual current cash flow, you have to ask, when are the profits going to show up to justify this price? And history's lesson here is pretty harsh. When valuations get this stretched, a painful correction often follows. Now, crazy valuations are one thing, but when you add leverage to the mix, that's when things get really dangerous. Today, speculative tools like margin debt and hyper-focused ETFs are just pouring gasoline on the fire. Think of leverage like a seesaw. It pushes your gains way higher on the way up, sure, but it makes the drop on the other side much faster and much harder. It turns a simple correction into a potential crash and makes the whole system a lot more fragile. All right, so with valuations stretched and leverage making things fragile, it really forces us to take a step back and ask a fundamental question about what we're actually doing here. And that brings us to the critical difference between investing and speculating. Speculating is just betting on a story. Investing is buying a piece of a real, durable, cash-producing business. At the end of the day, this is the simple truth. Hype dies down, stories change, but over the long haul, The market always comes back to rewarding companies that generate real, sustainable profits. The dot-com bust wasn't the end of the internet. It was just a shakeout that separated the real businesses, like Amazon, from the ones built purely on promises, like Pets.com. So, how do we find those durable companies that are built to last? Well, we look for something called an economic moat. A moat is just a term for a sustainable competitive advantage. It's the unique thing that protects a company's profits from competitors, year in and year out. Honestly, it's the single most important quality to look for if you want to own businesses that can not only survive a downturn, but actually come out stronger. And what does a real moat in the AI world actually look like? Well, it is not just a cool story. It's proprietary tech that's incredibly hard for anyone else to copy. It's consistently high profit margins. It's a structural advantage, like, say, controlling the manufacturing of the essential chips everyone needs. And maybe most importantly, it's proven measurable revenue coming in from AI products right now, not just a promise of revenue sometime in the future. Okay, so that's the theory. How do we put this into practice? I'm going to give you 3 simple, practical rules that you can apply to your portfolio today. This is a framework to help you manage risk and survive, maybe even thrive, if this AI story hits a major speed bump. The framework is pretty simple. Number 1, stress test your holdings to figure out what you truly believe in. Number 2, focus on companies that are already turning all this AI hype into actual cold, hard cash. And number 3, build up your liquidity and optionality, because in a downturn, cash is king. All right, this might be the single most important stress test there is. Look at every single one of your AI-related stocks and ask yourself this question. And be honest, if the price got cut in half tomorrow, would you be a panicked seller, or would you be excited to buy more of a great business at a fantastic price? Your answer tells you everything about whether you're an investor or a speculator in that stock. Now, part of that stress test is just basic portfolio management. I'm talking about position sizing. No matter how much you believe in one company, you have to maintain discipline. As a general rule of thumb, capping any single tech stock at around 3 to 7% of your total portfolio is a really smart way to manage that concentration risk. It ensures that one disaster doesn't sink your entire ship. So I'll leave you with this final thought. There is no doubt that AI is going to change our world. The promise is real, but the market's job is to deal with uncertainty. And right now, it's pricing in near perfection. By respecting history, focusing on the fundamentals of a business, and managing your risk with discipline, you can position yourself to benefit from the long-term promise of AI without getting wiped out by the short-term hype. So the ultimate question you have to answer is, which one is your portfolio built for?